Welcome to Talk Tickers. I'm your host, and today we are looking at, well, the bedrock of your financial life. We usually spend our time here talking about how to grow money, earnings, growth stocks, yield curves.
All the exciting stuff.
But today, we're talking about how not to lose it.
It's the defensive playbook. And honestly, it's the one topic that, nobody really cares about until the moment panic sets in.
Exactly. We are doing a deep dive into cash management. Specifically, the Federal Deposit Insurance Corporation, the FDIC, and the reality of those insurance limits. The headline summary is basically this: that $250,000 limit you see on the sticker in the bank window. It is not a hard wall.
Not at all.
It's a building block. And if you know the rules, you can legally and automatically insure millions of dollars at a single bank. But if you don't know the rules and you're maybe relying on a government bailout like we saw with Silicon Valley Bank, you're taking a risk.
A huge one. And it's a risk that doesn't show up on your balance sheet until it is far too late.
That's the perfect setup. This is about distinguishing between what the law guarantees
and what you hope the government will do in an emergency.
So let's get right into it. March 2023, Silicon Valley Bank and Signature Bank collapse.
The second and third largest bank failures in U.S. history.
Total panic. But then the government steps in.
Right.
They cover everyone. Even the people with $50 million in the bank got every single penny back. So play devil's advocate for me here.
Okay.
If I'm a listener sitting on, say, $5 million in cash, why should I even care about these limits? The precedent has been set. The government isn't going to let depositors burn, right?
That is, without a doubt, the single most dangerous assumption in finance right now.
Wow. Okay.
What happened with SVB was the invocation of something called the systemic risk exception, or SRE.
SRE.
You have to understand the mechanics of that decision. It wasn't automatic.
It wasn't just a switch they flipped.
No. Okay. It required the Treasury Secretary, the Federal Reserve Board, and the FDIC board to essentially vote and say, if we don't save these specific depositors, the entire economy might collapse.
And then they had to go to the president.
Then they have to go to the president for consultation. It's a discretionary panic button.
Completely discretionary.
That's the key. It is not the law. The law is the statutory limit.
Yeah.
If your bank fails, let's say it's some regional bank in the Midwest, and the government decides its failure won't crash the global economy.
You don't get the SRE.
You don't get the SRE. You get the standard receivership process.
Which means you are basically standing in line with everyone else.
Exactly. You become what's called a general unsecured creditor. I get 80 cents on the dollar. You might get 50 cents.
And you might wait years to get it.
You could wait 3 or 4 years to get it. So relying on a bailout is basically betting your liquidity on the mood of the Treasury Secretary.
Not a strategy I want to bet my payroll on.
No.
So let's strip this down. If we can't rely on the bailout, we have to rely on the hard rules. The core number is $250,000.
Right.
But the definition is where people get tripped up. It's $250,000 per depositor, per insured bank, for each account ownership category.
That phrase, ownership category, that is the secret sauce.
Right.
Most people stop reading at $250,000. But the FDIC views you differently depending on the hat you are wearing when you deposit the funds.
Okay, let's walk through this practically. Let's take a DIY approach. Suppose I'm a high net worth individual, or maybe I just sold a business, and I have $3 million in cash. I love my local bank, and I really don't want to open 12 different accounts at 12 different banks all over town. How do I stack these hats to get coverage?
All right, let's build a stack. We start with a single account.
The most basic.
The most basic category. It's an account in your name only that gets you $250,000 of coverage.
Okay, that's the first $250,000. Easy.
Now, assuming you have a spouse, they also have a single account category. So they open an account just in their name. That's another $250,000.
So now we're at $500,000 total for the household.
Already. And now we look at joint accounts. This is a totally separate ownership category.
Right.
The rule is that a joint account is insured up to $250,000 per co-owner.
Wait, pause there. That's important. So if my spouse and I have a joint checking account, is the total limit $250,000 or is it $500,000?
It is $500,000 for that specific account. $250K for you, $250K for your spouse.
And that doesn't eat into our single account limits.
Not at all. It creates a fresh limit.
So just between me, my spouse, and our joint account, we have $1 million fully insured at one single bank.
Precisely. $250K single, another $250K single, $500K joint. Statutory ironclad coverage.
Okay, we're at $1 million. But I said I have $3 million. Where do we go next?
Next up, certain retirement accounts. This includes your IRAs, Roth IRAs, self-directed KIOs.
Or get their own bucket.
Their own separate bucket. The limit here is $250,000 per owner. So you have an IRA. That's $250K. Your spouse has a Roth. That's another $250K.
So now we're at $1.5 million, and we haven't even touched the complicated stuff yet.
Not yet.
Let's talk about trusts. This is where I know the rules changed recently, right? There's a big update in April 2024.
Yes, and this is critical for anyone with an estate plan. Before April 2024, the rules for trust accounts, revocable versus irrevocable, were, frankly, a nightmare.
Really?
Oh, yeah. They involve things like contingent interests and looking at the specific legalese of the trust deed. It was very easy to screw up.
And if you screw up the titling, you lose the insurance.
You lose the insurance, exactly.
Yeah.
So the FDIC simplified it. As of April 1st, 2024, the calculation is much more straightforward.
Okay.
A trust owner is insured up to $250,000 per eligible beneficiary.
So if I have a revocable trust and I name my 3 kids as beneficiaries,
then that one account is insured for $750,000. It's just $250,000 times 3.
what if I have 10 kids or I want to list my nieces and nephews? Can I just keep scaling this infinitely?
No, and that's the catch with the new rule. While they simplified the math, they did add a ceiling.
Ah, okay.
Coverage is now capped at $1,250,000 per owner per bank for these trust accounts. So basically they cap you at 5 beneficiaries.
So you can't game the system by listing 20 people. But still, $1.25 million is a pretty significant chunk of change.
It is. So let's go back to your $3 million scenario.
Yeah.
You have $1 million in personal and joint accounts.
Right.
You have 500Ks in IRAs.
Mm-hmm.
And now you can comfortably add another $1.25 million in a trust account if you have 5 beneficiaries. You're getting very, very close to that $3 million number.
All at one bank.
All at one bank, all fully insured. And we didn't even mention business accounts.
Right.
If you have a corporation, a partnership, an LLC, that entity is treated as a separate depositor. It gets its own $250,000 limit, completely separate from your personal accounts.
It's impressive that you can do this, but I have to be the cynical host for a second here.
Go for it.
This sounds like an administrative nightmare. I'm picturing myself trying to manage cash flow across 7 different account numbers, moving money from the joint to the single to the trust just to pay a bill.
Yeah.
Is there a way to get this coverage without turning my life into a spreadsheet?
That is the reaction most people have. And that is why the hands-off method exists. We're talking sweep networks.
Okay.
You might know them by the acronyms ICS or CDRs. The whole network is run by a company called Intrafi.
I see that logo in the fine print on bank websites all the time. Member Intrafi network? How does that actually work?
Think of it like a daisy chain of banks. Let's say you have that same $3 million. You walk into your primary bank, we'll call it Bank A.
Okay.
You deposit the full $3 million with them. You sign one signature card. You log into one website.
So the user experience is one bank.
Exactly. But behind the scenes, Bank A can only insure $250,000. So their software automatically sweeps the excess, the other $2.75 million out to other banks in the network. It sends $250,000 to Bank B, $250,000 to Bank C, and so on.
And I don't have to open accounts at Bank B, C, and D.
Nope. You don't even know who they are until you get your monthly statement. The statement will just list the holdings.
So because the money is physically residing at different institutions, I get the pass-through insurance of each one.
That's it. You get the safety of a diversified portfolio of banks, but the convenience of a single relationship.
This seems like a no-brainer for corporate treasurers. If I'm running a payroll of $10 million, I can't be messing around with trust beneficiaries.
It is the standard for institutional cash. And brokerage firms do this too. If you have a cash account at Fidelity or Schwab, they use these program banks. They sweep your uninvested cash across a lift of banks to give you $1 million or $2 million in coverage.
I want to touch on the institutions themselves for a moment. We keep saying banks. Does this apply to credit unions?
Yes. From an insurance perspective, they are virtually identical.
Okay.
Credit unions are regulated by the NCUA, the National Credit Union Administration. The limits are the same, $250,000. The structure is the same, and the backing is effectively the same full faith and credit of the U.S. government.
So no safety penalty for going with a credit union?
None whatsoever.
Here is a trap I know people fall into. Branch logic. I've heard people say, oh, I'll just open an account at the Chase on Main Street and another one at the Chase on Broad Street.
Yeah, that does absolutely nothing.
Why not? They're different buildings.
The FDIC insures the charter, not the building. If you deposit money at a branch in New York and a branch in California, if they're part of the same legal banking entity, they get aggregated.
So you have to go to a completely different bank.
A different bank entirely to reset your limit. Don't be cute with geography.
Let's zoom out a bit. We talked about the SVB bailout. I want to understand why the government is so hesitant to just blanket guarantee everything. Why do we have to jump through all these hoops?
It comes down to cost and moral hazard. You have to look at the history here. The FDIC was created in 1933, and for decades, there was a specific mandate in the law called the least cost test.
Which means exactly what it sounds like.
The FDIC was legally required to resolve a failed bank using the method that cost the insurance fund the least amount of money.
So they were obligated to be cheap.
Right. And usually the cheapest way to close a bank is to pay off the insured people up to the limit.
And let the uninsured people take a loss.
Exactly.
So historically, how often did uninsured people actually lose money?
If you look at the data pre-2008, so before the great financial crisis, uninsured depositors took losses in about 63% of bank failures.
Wow. So nearly 2/3 of the time, if you were over the limit, you took a haircut.
Yes, you were a creditor. But post-2008, that completely changed. Since 2008, uninsured depositors have lost money in only about 6% of failures.
That is a massive shift. Why?
The interpretation of risk changed. The government realized that in a modern, interconnected economy, letting a bunch of businesses lose their operating cash causes a domino effect that is actually more expensive to fix in the long run.
But that shift comes with a price tag, right?
It does, a big one. From 1992 to 2007, the cost to resolve a failed bank averaged about 10% of the bank's assets. Post-2008, that number jumped to 18.2%.
So it costs nearly double to save everyone.
Exactly. And that money has to come from somewhere. It comes from the Deposit Insurance Fund, which is funded by assessments on all the other banks. If the FDIC just guaranteed everything, the fees on banks would skyrocket.
And rates paid to savers would drop.
Right. It would fundamentally change the banking business model. That's why they cling to the $250,000 limit. They need a cap on their liability.
That makes sense. It's a balance between stability and cost. But for the individual listener, we don't care about the macro costs. We care about our money.
Of course.
So is there any scenario where doing all this work structuring trusts, setting up sweeps isn't worth it? Why not just leave the banking system?
Well, if you truly want zero risk, if you don't trust the FDIC, you don't trust the sweep networks, your only real option is U.S. Treasuries.
T-bills.
T-bills. Direct obligations of the U.S. government. They aren't insured because the government is the issuer.
Right. If T-bills fail, we are trading canned beans and ammo.
We have bigger problems.
Yeah.
Exactly. You can also use government money market funds, which invest in T-bills for you.
Yeah.
But you have to be careful. You want a government or Treasury money market fund, not a prime fund.
Because prime funds can hold corporate debt.
And corporate debt can default. So if you want absolute safety, you buy Treasuries. If you want convenience and liquidity, you use the banking system, but you structure it.
That's the hierarchy.
That's it.
So let's bring this down to a practical takeaway. If I have a meeting with my banker tomorrow, and let's be honest, bankers are salespeople, what is the one specific thing I need to ask them to cut through the marketing fluff?
You need to ask a two-part question. First, does this institution participate in a reciprocal deposit network like Intrafi?
Okay.
And second, if not, can you explicitly map out my uninsured exposure across my account ownership categories?
I love that second part. Explicitly map out my exposure.
It forces a change in the conversation. Usually a banker will say, oh, don't worry, we're very well capitalized. We've been here for 100 years.
Which is a probability argument. We probably won't fail.
Right. But when you ask them to map your exposure, you are asking a legal question. You are forcing them to admit, okay, legally, this $500,000 is at risk.
It moves the conversation from trust us to here is the contract.
And that is the only place you want to be when you are dealing with your life savings.
It really highlights that the cost of safety is surprisingly low. We're not talking about buying expensive derivatives or anything.
No, the cost is a little bit of paperwork, maybe an hour of admin time to set up the trust correctly.
Or a slightly lower yield on a sweep account.
Maybe.
Yeah.
But think about the asymmetry. The upside is 100% principal protection. The downside is
Filling out a form.
Exactly.
Oh.
If you don't do it, the downside is losing maybe 15 or 20% of your liquidity instantly and having the rest frozen for months. It's cheap insurance.
Before we wrap up, I want to leave the listener with a thought on the bigger picture here. We've spent this time explaining how to use the rules to effectively get unlimited insurance. If every corporation and every wealthy individual actually did this, if everyone used sweeps to fully insure every dollar, We are effectively shifting the entire liability of the U.S. banking system onto the FDIC.
That's true. We're privatizing the convenience and socializing the risk on a massive scale.
So does the Deposit Insurance Fund actually have the math to back that up? If a massive crisis hits and everyone is fully insured because of these sweep networks, does the full faith and credit hold up?
Or does it just become a euphemism for the Federal Reserve printing money to fill the hole?
That is the trillion-dollar question.
If the liability becomes total, the backstop has to be infinite. And the only entity with an infinite balance sheet is the printer.
Something to think about the next time you look at that FDIC logo. Thanks for listening to Talk Tickers.